Hi, and welcome back again to Tim Bingham's Options and Volatility newsletter, powered by Buy Alerts and Pilot AI. Today, we're going to be taking a look once again at why IV matters, why implied volatility is, in my opinion, the most important concept in option trading. Take a look at the S&P 500 ETF, the SPY puts, now versus back on the Liberation Day lows. Once the market started heading higher, found some support when it broke back above the 20-day moving average. So let's jump in and take a look and see how much things have changed now versus then. So here's the date we're looking at on April 25th, right, when the S&P 500 ETF SPY broke back above the 20-day moving average after finally getting a little semblance of sanity after a vicious sell-off on the tariff tantrum Liberation Day lows. You can see since then the S&P 500 really has not been below the 20-day moving average at all. We've had actually 5 days that it closed below there, none of them meaningful by any means, right? No big, piercing of it like we have seen in the past. Even here, we haven't come close to this sort of move, which is more normal. This has been one of the most orderly, if you will, rallies, very quiet, and I think perhaps getting too quiet indeed. So you can see market getting slightly overbought on some of the technicals, but MACD has not had a meaningful move in basically the last time we saw the market dip below that 20-day moving average. So this is one of the longest stretches in market history, right, where we've seen stocks generally stay above the 20-day moving average, right? And we'll take a look at the valuations, what they're getting to as well, and why it might be time on that front too. You can see also implied volatility really has leveled off here, starting to pick up. So it might be time to jump in and play for that probabilistic pullback. Protect the portfolio, certainly not a bad time given the fact how cheap options have become overall. Just how cheap. I took a look basically now, right? SPY closed at 669.21 on Friday. For all intents and purposes, right at the all-time high again, right? Virtually unchanged. The 21-day pretty much at the money, 669 put, right? It's only 21 cents out of the money, closed at 723. It only cost a little more than 1% the price of the SPY to ensure, if you will, the portfolio for 21 days, right? And any sort of pullback, right, of any magnitude, anything more than 1.11%, right, would lead to that intrinsic value exceeding what we paid for the option, right? The break even, 661.77. IV, fairly cheap, certainly at 12.87, right? The short end of the curve getting really cheap compared to kind of the mid part of the curve as well. Compare that to back on that April 25th point where we said we saw finally the market break out back above the 20-day moving average. So we're comparing it to this period here, right? You can see the SPY was at 546.69. This is from April 25th I pulled off. So the SPY is actually 122 points cheaper now, which normally you would think that having a lower SPY, right, would lead to less expensive options, generally certainly puts as well, right, simply because the higher the underlying goes, the more expensive the options become as a function of the price, right? But instead we see that 545 put, right, which is slightly out of the money, similar to the one we're comparing it to from Friday, right, closed at 940 or over 2 points cheaper, right? So even though you saw the SPY rally over 18%, right, that similar put, and it's actually a little bit further out of the money, and we'll see in a second with a week less to go, actually was 30% more expensive, 2 points higher. As far as the price of that put versus the SPY back then was 1.71%. As we said, Friday it was looking just over 1%. Again, 21 days to expiration we're looking at Friday. Only 14 days back then. So a week less time is what I did the comparative on. Certainly less time should make the option cheaper, but as we said, the option is more expensive. So the lower price of the SPY by 18%, a little bit more, should make the option price cheaper, right? A week less time to expiration should make the option price cheaper. Out of the money by more, we're now 1.69 points out of the money, right? A bigger percentage, right? Over, this time here, where we're only 21 cents out of the money, and certainly on a basis of the price of the underlying, right, should make the option cheaper, right? Further out of the money puts that have less time to expiration on a lower price stock. Everything equates to a lower price option, but lo and behold, that option is actually 30% more expensive, over 2 points more expensive. Why? Because IV shot up, almost doubled, right? IV on Friday's close was trading just under 13. Back then, it was approaching 25. So a 91% higher IV back then means the option prices were much more expensive, right? So it certainly makes sense now to jump in, I think, and at least take a portfolio protector or a slight position in some puts here. And certainly valuations have changed as well dramatically. So I take a look at a couple of the major ones. Here's price to sales back then versus now. You can see price to sales now almost approaching 3.4 times price to sales for the S&P 500, which is the highest level in history, as you can see here, right? The last time, back on April 25th, price to sales was under 2.8 times, right? And certainly fairly cheap comparatively over the past year or so, right? This is by far the richest valuation we've seen. Yeah, maybe growth is coming, but you're paying a huge price for growth. You can also take a look, right, at PE ratio, the same thing, right? PE now on the S&P 500 getting near 30x, right, which is, again, the highest level over the past year. You can see that back at the lows, it was under 26x. So the market getting expensive on a valuation basis, no doubt. You can see the last time we had the PE up here, we'll take a look in a second, is the last time we saw the market have any sort of that pullback, right? We'll also take a look at going back on the price to sales to, the last time it was over 3x briefly, right? Here's COVID, which, it lasted boom and dump, right? Then we saw the last time was February of this year, right? And when we take a look at the chart, you can see here's where the market was the last time price to sales was over 3 times, right before a big pullback. Forget the Liberation Day tariff tantrum, right? This was a pullback based more on the fact that maybe valuations were getting extended here. Yeah, interest rates are coming now, but the long and the 10-year yield still above 4%. The Fed going to put Fed funds to 3.5%. It certainly doesn't equate to this huge multiple expansion, right, at all. So we're seeing the market at the highest valuation level we have seen in history on price to sales, and on a PE basis, by far the highest of the year. As we said, the last time we saw the market approaching that, right, was that same time frame on a PE basis, right, which was here. So valuations getting to levels and exceeding levels that previously led to pullbacks as well. And just on an interesting note, right, I like to take a look. The top 10 stocks in the S&P 500 now have the biggest concentration on record. What does that mean? The top 10 stocks basically equate for almost 40% of the index. The other 490 stocks, only 60% of the index. And this was from a while ago. I actually pulled it off from Friday's close. We're now approaching 40%. Google, you put together here, it actually belongs at number 4 on the combined market cap stock, but because you have the voting and non-voting. But you can see that this concentration, right, where everyone is rushing in to these big names, driving up PEs, not caring what they pay, I think sets up at least sometime, right, for a pullback. It doesn't even have to be of a big magnitude, right? Because those option prices, as we said, have become so cheap with the IV under 13 here. And remember, if we do get a pullback of any magnitude, you'll see IV head higher, which is a benefit for option prices generally, and probably puts particularly, you'll probably see the skew and the term structure of vol start to flip more towards the puts than the calls as it normally does. So I think the probabilities, the odds favor somewhere along the way a pullback. We'll see if it's over the next 3 weeks here. Certainly you can go further out in time and play for longer. But I think given the fact that we've had this huge long stretch without any sort of really issues on the stock front, probably pays to stay short term. So until next time, as always, here's the good trading. And as always, trading is about probabilities, not certainties. Take